Hi, this is David Hawksworth, the insurance coach with USA Benefits Group. And today I wanted to talk about a health insurance concept called the Total Protection Plan. This is a strategy that I recommend to many of my clients and educate my clients about. My philosophy of being a health insurance and life insurance broker is to educate my clients so that they can have the information that they need to make the best decisions for themselves and their family and their finances. And the that's why I kind of call myself the insurance coach, because I coach sports, but I also think of myself as a coach in the insurance business as well, to educate and train people, in particular my clients, about the ins and outs of life and health insurance. The Total Protection Plan is what I want to talk about today, and what this is a concept of providing better coverage, superior coverage, by packaging together health insurance along with some supplemental coverages in order to not only provide better coverage for an individual and their family, but also to, in most cases, at least in many cases, to do it at a lower premium, a less expensive option actually. So here's the concept. Very commonly, what people have as far as their current health insurance coverage right now, in many cases, people have, and this is what people tend to prefer, is they have a comprehensive style co-pay type insurance plan. There's nothing wrong with that kind of plan at all. It's a very good plan. The deal though with that plan is that a lot of people have these plans set up so they have a relatively low deductible. Maybe they have a $500 deductible or a $1,000 deductible or even a $2,500 deductible, and then they typically will have co-insurance as well, which I'll explain in another video, because co-insurance is often misunderstood or not understood by the average person. But anyway, they a lot of times have a lower deductible plan, and maybe their co-insurance is also high, and they have copays and so forth. And so all of this adds up to a tends to be a pretty expensive option, especially if there's a family, especially if someone isn't really young, if someone's in their late 40s or older. These kinds of plans can be very expensive. And if this person, if the person or the family is healthy, if they're a generally healthy person and they're generally, they're not chronically ill, they're not utilizing the everyday services of a health plan or even the major services of a health plan on a regular basis, in most cases, they are not going to ever satisfy their deductible in a given year. And it doesn't really matter if the deductible is low or if the deductible is high. They're never going to hit or satisfy their deductible. So let's say someone has a $1,000 deductible right now, okay? And let's say they're paying $400 a month for that coverage right now. Okay, and let's say on a given year, a typical year, going back over the last 5 to 10 years of their history and looking at their utilization patterns with their health insurance and their health care, if they're not typically hitting their deductible, even if it's low, like a $1,000 deductible, and in most years, they're never using any of the deductible. And if they do use it, it's relatively small. Okay. So let's say out of 10 years, they've hit their deductible one time. That's actually pretty average. That's pretty common for the average American family to hit their deductible 1 out of every 10 years. that means that they're really not getting the most out of their health plan, and it's probably not the best fit for them. Okay, so the idea here is to take advantage, to leverage your good health and actually raise the deductible and potentially also lower the coinsurance. Okay, making it not as comprehensive a plan is the idea here. In addition, you could also opt for, if you're a healthy person or family, to either do away with or decrease the coverage on the minor services like the doctor's office visits, the urgent care visits, and that kind of a thing as well. All of those moves, all those maneuvers with your health insurance makes the premium go down. Okay, so the downside is you have a less comprehensive plan. The coverage is not as good. Okay, but so let's say you go from $1,000 deductible to a $5,000 deductible. Okay, you never hit your deductible, not typically, maybe 1 out of every 10 years when it was 1,000. So why not move it up to $5,000, because you're not going to hit it anyway, typically, and save some money on on your premiums every month. Okay, and then so that practically speaking, your coverage really didn't change for you in a typical given year because you weren't going to hit your deductible anyway. Okay, but now you're taking advantage of the cost savings. So let's say it was $400 a month before at $1,000 deductible, and let's say that we can get it down to $250 per month with a $5,000 deductible. That's probably a typical change in premium going between those deductibles. Okay, so now you don't have the comprehensive coverage anymore. So what we do then is we sort of activate or introduce the concept of total protection. Okay, what that means is you supplement now your health plan. Now that you have a higher deductible, now it has a higher out-of-pocket exposure. Okay, we supplement the health plan with policies such as accident insurance and critical illness insurance. Okay, accident insurance, what it does is it reimburses for any and all out-of-pocket expenses related to healthcare when it's related to an accidental injury of any kind. So it doesn't matter what kind of accident it is. It could be a car accident, but it doesn't have to be a car accident. It could be an accident in the home or in your yard or in public, or you name it, doing recreation anywhere. Okay, and it's going to reimburse all of your out-of-pocket expenses related to that up to the maximum set forth in the policy. Okay, so what we do, let's say you have that $5,000 deductible plan, and let's say there's another $5,000 of exposure from the coinsurance. Okay, so you have a maximum total exposure potential of $10,000 in a given year. So we would typically design the accident policy to be a $10,000 accident coverage policy. Okay, so in any case involving an accidental injury, you are actually going to have zero out-of-pocket exposure, because every single dollar all the way up to the deductible and the coinsurance is going to be covered by the accident policy. Okay, so now you have actually better coverage, superior coverage than you did with your $1,000 deductible health plan on its own. Okay, the other supplemental policy that we typically do is a critical illness policy. The critical illness policy works a little bit differently than the accident policy. The critical illness policy covers roughly a dozen different critical illnesses. Okay, so the typical critical illnesses that are covered are cancer, internal cancer, heart attacks, strokes, kidney failure, end-stage renal failure specifically, organ transplants, Alzheimer's, paralysis. So these are huge life-altering kinds of critical illnesses. Okay, and what this policy does is it pays the entire amount of the policy upon diagnosis. Okay, it's not a reimbursement. The entire face amount of the policy, whatever it is. So in this case, for the example case we're using, we would typically do a $10,000 critical illness policy. So let's say the person were to be diagnosed with internal cancer. The insurance company would cut a check for $10,000 to the insured, to, and the idea being that the money would be used to reimburse, for any expenses that are going on. Now, so that's the idea there, is just, and again, the coverage would be actually superior to what they had before with the $1,000 deductible without any supplemental policies. And the combined premium of the accident and the critical illness together with the health policy is typically less expensive than the old health policy was by itself. So let's say it was $400 a month before. Now it's the $250 for the health insurance plan, plus let's say it's $40 a month for the accident policy, and then maybe $30 a month for the critical illness. So you add $70, so you're at $320 per month versus the old one, which was $400. So you have a lower premium, lower out-of-pocket expenses on a monthly basis, plus superior coverage than you had before. And one more item that's really important to know is that statistically, in the United States, 83% of the cases where people are utilizing the major services of a health plan, so that's the hospitalizations, the surgeries, the major diagnostic exams such as MRIs and CAT scans, things like that, as well as emergency room. Those are your usual big services, and those are the ones where your deductible and your coinsurance come into play. Okay, 83% of the time that those services are being utilized in the United States, it's either because of a critical illness or an accident. Okay, it's only 17%, the remaining amount of the time, that it's some other reason. Okay, so by structuring your plan in this total protection type plan, this total protection strategy, you're almost always going to have better coverage than you had before at typically a lower premium than you did before. So it's a way to leverage your good health and get better coverage at a lower cost. And that is the total protection plan, and that is a very common strategy that I recommend for my clients. Thanks very much, and until next time, this is David Hawksworth. Bye-bye.
It's official. Health insurance exchanges are alive. But what exactly is a health insurance exchange? Government officials often compare the exchanges to online travel sites like Expedia or Orbitz. And having walked through some of the exchanges, that's a good comparison. It makes some sense. But given that many exchange websites might not even be live for a few weeks, I find it helpful to make another comparison, to picture a big box store, like the kinds that sell electronics or housewares, except the exchanges sell health insurance. Like many stores, the exchanges don't actually produce the products they sell. They sell products made by someone else. In this case, insurance plans created by insurance companies. The Affordable Care Act, or Obamacare, sets minimum requirements for insurance plans that are sold on the exchanges. So if an insurer approaches the exchange with a plan that doesn't meet their requirements, the plan won't get space on the exchange's shelves. The plans that meet the requirements get a rank: bronze, silver, gold, or platinum, based on their cost and benefits. The exchanges also make the costs and benefits of the plan as clear and easy to understand as possible, so customers can find the plan that's right for them. The theory behind an exchange is really the same idea behind a big box store too. By offering producers, in this case insurers, millions of customers, they can bring the cost of the products, healthcare, down by creating an economy of scale. And like big box stores, exchanges are also meant to bring a wider variety of products to consumers. The greater amount of choice is meant to increase competition and drive prices down further. But the devil is in the details, and there are, rightfully, some concerns about the exchanges. Box stores that succeed are great at marketing, communicating to consumers to understand what they want. That's not something that's been common in healthcare. And think about the showrooming effect too, right? You might go shopping for a big screen TV, but that doesn't guarantee you'll be ready to buy the first one you see. The exchanges are designed to be simple to use, but there's still a good chance that many Americans who will log on will get dissuaded by the process or prices that they see. Even if the exchanges become expert marketers, there are also concerns about how many people will use exchanges to find coverage. If there aren't enough, or if the mix of healthy and non-healthy patients isn't right, healthcare costs will go up. And even if the exchanges work as intended, that will add millions of patients to an already resource-constrained system. Some people think that could result in price increases and decreased access to care. If you want to learn more about the exchanges and how the healthcare industry should respond, visit advisory.com/exchanges.